Awesome. Welcome everyone to our week 6 debrief for iSPY Academy. This is focused on corporate finance essentials, a foundational topic that helps us understand how companies manage money, make decisions, and build long-term value. Today, we'll talk through the key concepts, recap what we should have learned throughout the pre-recorded lecture, and reflect on how it sets us up for next week's topic covering valuation of fundamentals. So, as you've probably noticed through the past few weeks, every single course builds or pre-recorded lecture week builds off of each other. So, the main goal of this week was to build that footing or that foundation as far as understanding that corporate finance side of things. What are these statements we should be looking at? How do those play a role in earnings reports? How do they play a role in the overall health and viability of a company, right? Their ability to stay afloat and the potential to invest in these companies long term. Before we dive into it, definitely want to make sure that you all are aware that we have this QR code here, sources week 6. When you scan that, it'll take you to a document where you'll see a bunch of links listed. This specific document provides you the majority of the sources that I use to build out the pre-recorded lectures and what a lot of our conversation will revolve around. As I've stated in the past, I don't expect you to treat me as the end all be all or to be the main source of all of this information, right? Because you should be able to take the initiative on your end to really develop this understanding for yourself and what it means to you and how you digest this. So really encourage you to beyond what we cover within these pre-recorded lectures and then the team meeting where we get to have a little bit more engagement with one another. I definitely need you to go out there and do your own research, right? Definitely a great opportunity or a start point within these sources to start doing that research on your end. So let's start with our learning goals for this week. We were all expected to develop an understanding of the core goals of corporate finance, including how companies raise, allocate, and return capital. Those are the three main things that we focused on this week, introducing three major financial statements and how each one answers a different question about a company's performance. Students also learn to distinguish between debt and equity financing, and we introduce the concepts of capital allocation and return on capital, which helps us assess the quality of leadership decisions. Lastly, we set the foundation for next week by helping us prepare to value companies based on these financial behaviors, right? Because what is covered in week 6 lecture when we talk about corporate finance essentials, it's the decisions that are being made when it comes to how money is being managed, how money is being made. So then how does that affect the actual valuation of the company? That's what we're leading into in the following week. So the first portion of our lecture focused on, well, what is corporate finance, right? That's the big question. Corporate finance is the decision-making framework behind how companies manage its money, and every public company, whether it is Apple, Amazon, or even maybe a company that you've never heard of, right? One that has just IPO'd, they all face the same fundamental questions. Number one being, where should we invest our money? Second, how do we raise that money? Are we looking at debt? Are we looking at equity? And lastly, once profits are made, how or what do we do with them? Right? How do we make this an enticement for those that are looking to invest? How do we make sure that all of the founders are being taken care of? How do we make sure that this company as a whole has long-term viability? So this section should challenge us to think like executives, not just investors. The emphasis to explore how good financial decisions like smart reinvestment, sustainable funding strategies, and disciplined profit return framework shape a company's long-term success and affect stock prices over time. So if you take anything away from today's conversation, the main hope or emphasis is that understanding or the mindset of how do companies work, those that are in leadership, the CEO, the CFOs, how are they analyzing their own company? How are they making sure that this company's health long term is stable? Right? The more that you're able to develop that understanding for yourself, the easier it should become to then analyze all of these different companies that you'll come across during your time in the market, right? Because you shouldn't simply rely on just looking at a chart and seeing candles move up and down to determine where you should be allocating your money, what trades you should be entering, what should be within your long-term portfolio. These are all questions that should be answered within the fundamentals, right? So that is why this specific course, mentorship, however you want to perceive it, exists, is to be able to understand the fundamentals across the board, right? Because again, we're putting together the fundamental analysis. So what we're doing now, in addition to the technical analysis fundamentals, and then just the overall mindset, psychology, philosophy behind all of these things that occur. So that is why we haven't led into anything having to do with charts so far, because we first have to be able to develop this mindset and to be able to think as a company owner, right? Or some leadership individual that understands how does a company truly run. And we're getting towards the end of this understanding. So in the next few weeks, we're wrapping this up and then moving on to the technical side of things, which would be it's going to be a lot of fun. But first and foremost, we have to take care of this, right? We have to build the foundational understanding of investment, financing, and return. So now that being said, some of the key statements that we are looking into or that were introduced as the core financial statements, not from an accounting perspective, but from the lens of a trader or a long-term investor, is number one, the income statement. This tells us how much profit the company has earned over time. Second, the balance sheet. It's a snapshot of what the company owns and what it owes. Lastly, we took a look at cash flow statements, which answer the real world question. Is this company actually generating usable cash? So we state this as the real world question because this is one of the biggest things that a lot of these investors, a lot of the individuals that are finding themselves within the market, that's one of the biggest things we're looking for, right? So we emphasize how all of these statements or these initial three statements are connected and how investors use them to detect financial strength, any sort of risk, and overall your opportunity to take advantage, right? Is this something that presents an opportunity to enter an options contract? Is this an opportunity to take on shares and included within your long-term investments? So the biggest takeaway here is profit on paper doesn't always mean financial health. And cash flow often tells more of the story. So all of these are intertwined, but that's something that I definitely want you to take away specifically from the financial statements overview. When you start to dive into the capital structure and financing, we explored how companies fund their operations and growth. We really emphasized the opportunity to learn the difference between equity and debt, the trade-offs, the risk, and the implications for stockholders. Equity raises cash by selling ownership. That's definitely the core understanding that you want to have when it comes to equity specific. You're raising cash by selling ownership. So introducing new shares, selling a percentage of your company, well, whatever it might be. And then on the other hand, debt is raising money through borrowing, which you need to pay back at some point in time, right? We looked at the metrics like debt to equity ratio, interest convergence, and WACC. These are all tools that help investors assess how leveraged or stable a company really is. We also took the time to emphasize that capital structure is not one sized. It fits all, right? It's not a one size fits all. I say this because when you take a look at capital structure, it will look differently from company to company, from sector to sector, to field, right? So you really want to develop an understanding of what is a healthy company within this specific area, within this specific niche. So the way that you evaluate, the way that you that you analyze a chip stock, right? So if you're taking a look at AMD, if you're taking a look at Nvidia, if you're taking a look at Intel, you're not going to evaluate that company or analyze it in the same way that you would a utilities company, right? If you're taking a look at waste management, if you're taking a look at other industrials like Triple M, if you're taking a look at things like Palantir, if you're taking a look at things like Raytheon, you're not going to analyze those companies in the same way that you would a chip stock or a tech stock company, PayPal, financial tech, those sort of differences. Yes, you have these core concepts that you're building an understanding around, but also understanding that different sectors work in different ways, right? So I say this because a company, for instance, like Palantir or Raytheon or Boeing, right? These companies, what do they all have in common? Do we all know what some of those companies have in common?
Wait, say them again?
Raytheon, Palantir, Boeing, some of these industrial companies.
No.
They're all heavily subsidized by the government, or they hold some sort of government contracts, right? So when we're taking a look at a company whose income, earnings, their budget largely revolves around the contracts, the money that they're receiving directly from the government, you're going to evaluate that company a lot more differently than you would a chip company that isn't necessarily fully funded by the government, right? Or Apple or Meta, things along those lines. So I say this because a lot of and one of the big companies, Boeing, right? It's been struggling for a while. We all know that in the past few years, it's had a lot of incidents, right? Where some of their planes have gone down. There was that big that big deal. I want to say maybe like a year or so ago when mid-flight, one of okay. Oh, dang, it looks like we lost connection here. So give me a second here. I'm bringing it back up.
Yeah, the
Sweet.
audio went out for a second.
Yeah, we lost connection. Give me a second. I'm just gonna. Oh, okay. Yeah, we're still going. Sweet. Yeah, sorry about that. We can just go ahead and keep going. But like I was saying, Boeing, for instance, right? It's had a lot of troubles when it comes to its viability or what we thought made it viable or not. But one of the biggest things that I've heard recurrently is that if Boeing fails, the US government fails, right? So why has this company been able to stay afloat even after having flights that have been losing its parts, its actual planes going down, the misalignment or um, allocating funds in ways that have been a little bit questionable, and why at current point in time, why are they receiving this huge influx of money from the Middle East, right? If you've been keeping up with the news, they recently got their largest ever order from the Middle East. So why has this company remained viable? Because it's largely subsidized by the US government and other governments, right? So I'm just bringing this up because again, that company's viability isn't really solely focused on how many planes are they able to sell, and the overall market sentiment. It's not affecting that company as much because it's heavily funded by government contracts. Same thing with Palantir, Raytheon, but if you were to, I know they're not in the same industry, but then if you take a look at um, companies like Meta, when we were, I think it was lows of like 20, like October 2023, when Meta was hitting some of its lows in like a decade or so. What drove it down? A lot of it was the mismanagement of money because they started like every other company pouring money into crypto, into the metaverse, into all of these different things, right? And at that point in time, investors just couldn't wrap their head around why is this being done? Why are you sinking so much money into this that isn't providing a return on that investment at this point in time, right? So that started to drive valuation down. So different companies dealing with different things, but these are the core components that we're looking at no matter what company falls within what sector. Awesome. Taking a look at capital allocation and specifically return on capital. Awesome. Once a company has raised money, what happens next, right? That's where capital allocation comes in. We walk through how companies choose to use their profits, whether it's reinvesting into operations, paying down debt, issuing dividends, buying back shares, acquiring other businesses. There's lots of ways that they make use of those specific funds. So when you're taking a look at those things, you then have to consider things like your return, your ROE, so efficiency with equity, or your ROA, which is efficiency with assets, and especially the ROIC, which it dives into, or what it shows is the company's efficiency with all capital, right? This tells us how a company is making use of their capital across these different ways that we talked about. Companies that generate high returns on invested capital are often those with competitive advantages like strong leadership and disciplined decision making. This section specifically laid the groundwork for understanding compounding businesses versus those that just coast on cash flow, right? That are just essentially making it paycheck to paycheck, quarter to quarter, based off of the money that they are bringing in. So these are the key metrics that you want to focus on, and really make sure to dive back into within the pre-recorded lecture itself. We then used all of that initial understanding that we were building to bring it all together, right? Through this specific case study where we analyzed Apple as a real world case study. We examined how Apple balances massive revenue and strong profitability with smart use of their debt and disciplined capital allocation. They, over the last few years, have issued over 500 billion in buybacks. Do we understand or are we familiar with that sort of impact or what it means or the reasoning behind doing those sort of things? One of the biggest reasons why we really emphasize these sort of things or why the market digests it in certain ways is that you're showing overall strength, right? If a company is willing to go out to the market and snap up billions worth of their own stock, they're betting on themselves, right? You are essentially what you're doing at that point in time as well. You're shrinking the overall availability of those shares. That's not to say that they couldn't then turn around and sell off all of that they just repurchased, right? But what you're doing is you're limiting the supply. So if you take a look at things like your basic bare bones understanding of supply and demand, you're shrinking the supply, causing there to be a greater demand or more demand than there is supply. So overall, the intent is to increase the value of those shares. When you take a look at the steadiness that they've done this in the dividends that they've been able to issue and their acquisitions, you're looking at a very strategic research and development, right? When they are able to look at the full board of what are all the components that play a role in our valuation and hit on each one of these components or to strategically plan out how can we address certain shortages or how can we address certain pitfalls, downfalls that we are currently seeing. This is what leads to that sort of eliteness, right? When we talk about Apple having a return on investment capital, initial capital at around 40%, that is seen as elite because of the bet on themselves, right? And the overall cash flow that they've been able to produce. So all of these different components that we've touched on that they've been able to excel because of the stock buybacks, the dividend issuance, the investment in specific development, whether it's new product development or introducing AI features into their already existing products and their innovation, right? In pushing the specific field forward as not necessarily being reactive and saying, oh, we now need to produce this, we now need to produce that. They've always been an innovator, right? So they've heavily invested in that research and development and figuring out what are the current stressors that people that customers are facing and how can we potentially make that easier, right? Whether it's going from the traditional cell phone to a touch screen to a tablet to these different computing equipment that they've been able to produce. Now having the Apple Vision, right? Their VR goggles, things along these lines, always being technically first to market with a lot of these things. But then in turn, you take a look at you take a look at um, other companies like AT&T, right? And I love to focus on AT&T because they have done so bad for themselves. Yes, it's a comm company. It's been rather stable, but they've missed out on huge opportunities. Companies like AT&T, which made costly acquisitions, over leveraged themselves, they lost investor trust, right? So if you take a look at the business or the way that AT&T has situated itself in the past decade, if you are all are familiar with AT&T, for instance, what are some of the acquisitions that they've made? They tried to get into well, they have gotten into not just the cell service and the internet service side of things, but what's another part of communication sector? It's the television side of things, right? So one of the companies that they bought out was a cable provider. Is Dish, right? If I'm not mistaken, Dish Network. They took them under their umbrella. That was a very costly acquisition for them, and they couldn't sell the product. And what did they do? They acquired HBO, or they like rebranded it. So they tried to they've been late to the game. Is trying what I'm trying to get at is they saw these cable companies growing, but they bought out or looked to buy out a cable company once it was already once that sector was always already like saturated. So once that happened, they then started to realize, well, Netflix is growing, Roku's valuation is growing, Disney streaming platforms growing. So do they do? They take on HBO, HBO Max, Max, whatever you want to call it, because it's been rebranded so many times as a competitor for to those streaming services. So they've sank a lot of money into different acquisitions to grow their company, but they haven't done so in a strategic way like a lot of the other companies within their own sector have done. So this is very troublesome because the more you pour money into something that isn't working, you start to lose investor trust. People start to sell off their shares. People don't want to be long-term invested into these companies that aren't able to think thoroughly and invest wisely. So the point wasn't to praise Apple within this specific section. It's to help us see or understand how corporate finances or corporate finance decisions directly impact market value and investor confidence. So I'm not here breaking it down for you and saying, hey, the X, Y, and Z, look at these charts. That's what I want you to do, right? We provided you the overall breakdown of the numbers within the pre-recorded lecture. So the hope here is that you take the time to deep dive into both of those charts and look at what has Apple done in comparison to AT&T, or even if you want to compare within sectors, if you want to take a look at communication as a whole, compare AT&T, compare Verizon, compare T-Mobile. Why is it that T-Mobile in current day is the leader outpacing the entire sector? Right? We touched on this a few weeks ago when we took a look at this sector specifically. It's when we did our quarterly ETF breakdown. If you take a look at T-Mobile's overall business, the strategy that they've employed, where have they been growing the most? They've been growing the most where communication companies haven't traditionally found themselves. For instance, T-Mobile has seen the largest spike in the Latin Hispanic communities, right? Those that tend to be lower income, underserved areas. You've been hitting that market with a lower price point, and instead of trapping, or I shouldn't say trapping, instead of hooking people into these long-term contracts, right? Because I think about When we used to have AT&T at some point in time, you were required to sign yearly contracts, right? Or 2-year contracts to keep a certain um, price on your monthly payment for that set amount of time. Once that contract was wrapped up, it would then either raise or you might be offered a different sort of plan where you could probably get a reduced price, whatever it might be, where some other companies started to employ no contracts. Right. It was more of like a month to month agreement. So you're not obligated to stay with the company. But what are they doing? That they're still hooking you because, yes, they're not offering you or they're not obligating you to take on a yearly plus contract for your service, but a lot of the times what they offer you are free or quote unquote free devices, right? But they're not really free because what they're doing is they're giving you it shows up on your bill, on your statement, that they're giving you a monthly credit to cover the cost of financing the phone. So if at any point in time you decide, hey, actually, I'm 2 months into this, I don't want this service anymore, great, you're set to leave, but you still owe the phone, right? Because the phone hasn't been fully financed or you haven't received the total amount of credits for the phone, because typically they disperse these credits over like a 2-year time frame. So they're still kind of hooking you on, but they're presenting it differently, and it's enticing a lot more buyers to come in, right? Or even if you don't finance a phone, where it becomes really beneficial is when you already have a paid phone and you come in and all you're doing is getting the monthly service. And in addition to that, they've now found themselves in rural areas, right? If you take a look at what T-Mobile's been doing, especially with internet, because T-Mobile now offers their own internet services, and it's not like dial-up wired connection. It's through cell service. So it's through their towers because they've been putting out or developing a lot greater infrastructure when it comes to their cell towers and the system that they use. In addition to this, they've partnered with Starlink, which is Musk's internet provider, right? So that provides cell phone and internet services through satellite. So what they've been doing is that they've now partnered with them, and they're right now in like beta test to see how does this coverage work within rural areas specifically that typically don't get an internet connection. So they've been really strategic in the way that they've tried to grow their customer base, the areas, the people that they haven't historically been able to acquire, and that's why their market share has grown significantly in comparison to AT&T and Verizon, some of these other providers. So definitely invite you to not only take a look at Apple and AT&T, because this was the specific real world example that we covered in this week's pre-recorded lecture, but really, really encourage you to do this within any sort of sector that you're interested in investing and develop that understanding of why is a company undervalued? Why might a certain company be overvalued? This company that's been running all year long, what have they been doing correctly? And what are other companies doing to potentially mirror that type of move and situate themselves, right? So, Kano, if you remember our conversation a few months ago now, we can even relate this specific case study to. Do you remember the semiconductor conversation we had?
Yeah, absolutely.
Yeah. So if you just to kind of recap the rest of the group here and whoever watches this online when it's posted, we had a really great conversation about why I was invested in Intel. At what was this? This was at the end of last year, like October, November timeframe, and why that was a good at the time short-term and even long-term investment because you see the semiconductors companies running, so NVIDIA, AMD. MU, TSM, Qualcomm, like all of these seeing this substantial amount of growth. But in comparison to that, Intel has kind of been stagnant, right? But us having the understanding that what made Intel back in the day the leader within that sector, it was their production side of things. They are a production business. They're not necessarily or haven't really ever been an innovative business like your Nvidia, like your AMDs are, where they are set to produce the new hardware to say this is how we can change things and make it faster, make it usable. How can we introduce AI to these types of things? That's not their business. So if you take a look at companies like TSM, Intel, and even Micron, their business is on being able to produce these things in massive quantities. So for Intel right now, it's been the case of how do we see the field uh, playing out? How do we see this moving forward in the next decade or so? And how do we reposition ourselves? Are we going to end up breaking this company up and selling it for parts? Or are we able to find our footing based off of what we have right now and start up what we were known for, that production side of things? Can we expand that and potentially be a producer again? Things along these lines. And off of that, too, how do we potentially increase our innovation if we are looking to compete, right? Because at this point in time, as you've seen across not just within chips, but across the sectors, across the market as a whole within our economy, what's the biggest thing that has been emphasized? American made, right? So the government itself is heavily investing or looking for companies to revamp their production within the state specifically. So this is where companies like Intel that are known as producers or were known as producers, that they have an advantage or they have the opportunity to say, hey, maybe we'll take on all of these government contracts and get certain grants from the government and things like that, to be able to expand if we're really willing to lean into these types of opportunities. So that is the bulk of what we covered within our pre-recorded lecture. Again, really encourage you to take the time to go back to it and dive into that overall breakdown and then come back to this conversation to develop a little bit more of that understanding in addition to the weekly lectures that we have where we talk about. I like to divide this up or think about this in the like the market academic side of things and then the mindset psychology philosophy side of things. We always have our portion titled beyond the charts, right? Because beyond the charts, beyond the analysis, beyond the textbook stuff that we cover, there's the need again to develop that understanding. And today's or this week's specific focus was the transition from strategy to mindset and introducing the idea of thinking like a CFO, so Chief Financial Officer, those that oversee the finances of a company, whether they're doing good or bad. That was the main idea of Beyond the Charts, looking into the decisions that move price. We highlighted the key moves CFOs make under pressure, delaying product launches, timing buybacks, or using debt strategically. All of these actions shape market perception and price. As a whole, we were introduced to the book The Outsiders by William Thorndike. That book, it's linked within our sources. It's linked, you'll find it within the Discord itself. So all of these sources, books, things that we talk about, they're all provided to you all. So definitely take the time to read it. Specifically, we assign chapter one, but this is definitely a book that should be read in it all its entirety. This is, I think, a powerful one because it profiles CEOs that outperformed right? And this was done through the foundation or through mastering capital allocation. So, one of the core messages within this specific book and the reading that we had is that the best company leaders aren't always loud and flashy, right? They're not always your typical CEO who's up in a conference with their fancy PowerPoint slides. I laugh because I think about how culture has changed and how things have been taken on. Like just this past week or so, Airbnb, right? They had their investor meeting and seeing how that presentation played out. Very reminiscent of a Steve Jobs presentation, right? So how do you go beyond just this, beyond being like a wow factor company and CEO? It really is rooted in the thoughtful, strategic, and consistency beyond behind planning, capital allocation, and the way that money is moving in and out of a company. So we really encourage everyone to adopt that mindset in their own analysis. And as we start to wrap up this conversation, that there are some assignments attached to every single week that we meet and the lectures that are provided. This specific assignment, it's aimed to reinforce everything from the lecture. Part one, you're asked to select a publicly traded company and evaluate its capital structure, the cash flow, allocation behavior, then decide, would you invest in this company based on how it manages its money, right? So this is the core of what we talked about today, everything that we've looked into, that's the heart behind the assignment, is to then nudge you to take the time to evaluate that company, because this is the initial part of what you'll do when we start to get to like the midterm area, and especially the capstone of this specific course or mentor ship, is that you're going to be required, and as a team we'll do this as well, to fully top down analyze a company, right? Analyze its fundamentals, because this is what you're going to be doing on your own on a day-to-day basis when you start to think about what companies should I be investing in, right? And Kano, we had a conversation, or what you reached out about a few days ago when you asked or you stated, hey, these companies, like we talked about them a few months ago, invested in them, but I wish I would have invested more, right? So this type of analysis and what the hope is here is that we're able to develop that strong understanding of how do I fully evaluate a company and make that decision whether I should go in heavily, whether I should limit my exposure, should I dollar cost average into it? All of these big questions, they all start with building this specific understanding. So I definitely am happy that we're having these conversations, because it's at the root of what will make us successful or not within the markets. And part two is the reflection of that company through the lens of the reading. So through the lens of the outsiders, is leadership behaving within the company that you're analyzing, is leadership behaving like a disciplined allocator, or are they just chasing growth? The goal is not to just analyze the number, but to assess the mindset behind the decisions that they're making. Because as we've covered through today's conversation and the pre-recorded lecture, financial habits, specifically good financial habits, just like you would have in your own personal finance, they determine long-term success, right? On the personal side of things, if we're just spending money as it comes, we're never building a foundation, right? If we're not investing in the long term, which is the biggest emphasis that I have here, my goal isn't necessarily to make you into a day trader. It's to help you build that understanding that if you want to be a day trader in the long term, you have to have a long-term portfolio, right? The long term is what leads to the means of being able to trade on a consistently basis and potentially making it a career for yourself. You need to understand the long-term investment side of things before we start diving deep into the options trading and the stock trading, things along these lines. That's something that I'll always go ahead and emphasize when we start to take a look at next week, right? Moving forward, we build off of all of this understanding, but start to shift from what companies do with capital to figuring out what they're worth, right? So, based off of those decisions, how does that lead into their overall valuation? And some specific valuation methods that we'll cover will be DCF models. PE ratios, PEG multiples, and how to link financial behavior with overall stock price. Is it overpriced? Is it underpriced? Is it of fair value? The aim of this is to help us identify undervalued companies and to learn to think like a long-term investor or a portfolio manager, right? How do you start to think like a hedge fund if you're taking a look at bigger term or bigger outlook? Um, as we move into discussion, things that I want you all to consider are what part of this week's lecture did students engage or did you engage with the most? Where did we struggle or where do we need reinforcement? Was it financial statements? Do we need more conversation around capital structure, on return metrics? This will be our opportunity to really refine, right, that understanding and to check for clarity. We really want to make sure that we're building fluency. I don't want this to be a matter of now being into week 6, right? Where we're into this 54-ish week course. We're getting into the solid foundation of it. So I don't want this to be something where we're just memorizing terms. I need this to be something where we're really creating fluency and we understand the ins and outs of it and we can hold these sort of conversations and build off of each other. So I definitely want to thank you all for being here and helping shape this program. Corporate finance is one of the most powerful lessons in investing. And when students really grasp these ideas, the whole idea or what we see play out and what I've seen personally in myself is that I've stopped reacting to price and I've started to understand what's really driving it. And that's what we need to do. Let's keep building toward that next level of insight, and the only or the healthiest way to do that is to build it one layer at a time, right? We're here to build it brick by brick. So thank you for spending time today. Definitely encourage you to join the Discord. You have the QR code here. If you have any questions that you didn't feel comfortable asking during the conversation here today, or if you're watching this as a recording on YouTube, the QR code here, those questions go directly to me. So you're more than welcome to do that. You can always email me as well. All of that information is going to be found below. And again, you have a link to all of the resources covering all of this information from the pre-recorded lecture and today's conversation as well. I hope you enjoy the rest of your day.
Thank you, David.